On Tuesday, April 15th, 2026, at exactly 2:23 p.m. Eastern Time, silver futures trading on the COMEX went completely dark. Not a glitch, not a technical issue. A full trading halt. For 47 minutes, the most liquid silver futures market in the world was frozen. No quotes, no trades, no price discovery. And when trading resumed at 3:10 p.m., silver had moved $4.30 per ounce. But nobody could tell you what happened in between. The official explanation from CME Group was volatility circuit breaker triggered due to geopolitical event escalation. That is exchange language for something happened that we cannot let trade freely right now. But here's what makes April 15 different from every other trading halt in COMEX history. The halt happened before any major news broke publicly. Iran had not announced anything. Trump had not posted anything. There was no explosion, no attack, no headline. The trading halt came first. The news came 90 minutes later. That 47-minute window is the most suspicious sequence of events in the silver market in the last 5 years. And today, April 23rd, 2026, 8 days later, we are finally starting to piece together what actually happened during that blackout. Because the data that has come out since April 15th does not match the story we were told. And the people who were on the right side of that $4.30 move when trading reopened knew something that the rest of the market did not. Let me show you exactly what I found. Start with the timeline. April 15th, 2:23 p.m. Eastern, trading halts. Silver last print before the halt, 83.45. April 15th, 3:10 p.m. Eastern, trading resumes. Silver first print after resumption, 87.75. That is a $4 to $1.30 jump in a market that was completely frozen. No trades happened during those 47 minutes. So where did that $4.30 repricing come from? Here's what we know happened during the blackout. At 2:51 p.m., 28 minutes into the halt, a container ship in the Strait of Hormuz reported an unidentified contact via emergency maritime channels. That distress signal was not public. It went to the U.S. Fifth Fleet and Regional Naval Coordination Centers. It did not hit Reuters or Bloomberg until 4:40 p.m., more than 2 hours later. But somebody knew at 2:51 p.m. And when COMEX trading reopened at 3:10 p.m., silver was already priced for a Hormuz escalation that the public would not hear about for another 90 minutes. Now ask yourself how a volatility circuit breaker gets triggered before the event that supposedly caused the volatility becomes public information. Circuit breakers are designed to pause trading when prices move too fast in response to known information. April 15th was the opposite. The halt happened in anticipation of information that had not been released yet. That is not a circuit breaker. That is a coordinated pause. Here's the second piece of evidence that something else was happening. In the 72 hours before April 15th, COMEX silver open interest dropped by 18,400 contracts, equal to 92 million ounces of paper positions liquidated. That is not normal pre-weekend positioning. That is advanced knowledge. Large players were exiting paper silver exposure in massive size in the 3 days leading up to April 15th. And then, in the 3 trading days after April 15th, open interest spiked back by 23,100 contracts, 115.5 million ounces added. Professional traders liquidated 92 million ounces of paper exposure right before a 47-minute trading halt and a $4.30 price spike. Then they re-entered with even larger positions immediately after. They sold high, waited, and bought back higher with more size. That only makes sense if they knew something was coming and knew the halt would create a repricing opportunity. I went through CME Group's official trade time and sales data for April 15th. In the 90 seconds before the halt at 2:23 p.m., there were 4,217 contracts traded. That is 21.08 million ounces transacted in 90 seconds. The average volume for that same time window over the previous 30 trading days was 680 contracts. April 15th saw 6.2 times normal volume in the minute and a half before the market froze. Someone was aggressively selling into the halt. And based on the open interest data, those same sellers became aggressive buyers when the market reopened 47 minutes later at a $4.30 higher price. They made money on both sides of a trade that happened during a market blackout. Now fast forward to today, April 23rd, 2026. We are 8 days past that trading halt. Silver is sitting at $77.70 this Thursday morning. That means silver has fallen $10.05 from the 80 at 11.75 post-halt spike. It gave back the entire move and then some. But here's the critical part. The physical market has not given anything back. Shanghai silver premiums are still $12 to $15 over COMEX spot. China imported 206.76 tons in January and February, an 8-year high, and import pace has accelerated in March and April. COMEX registered silver inventories dropped another 1.1 million ounces in the week after April 15th. Dealer premiums in the United States are holding firm at $3 to $6 per ounce with no downward movement, despite the paper price falling $10. The paper market gave back the April 15th spike. The physical market is behaving as if April 15 never ended. That divergence tells you everything. The halt was not about protecting market integrity during a volatility event. It was about controlling the paper price in the face of a physical supply event that threatened to break the pricing mechanism. Let me show you what happened in the 48 hours before that April 15th halt that nobody connected at the time. On April 13th, 2 days before the trading freeze, the Reserve Bank of India intervened in foreign exchange markets to defend the rupee. The rupee hit 91.7 to the dollar, an all-time record low. India is the second largest physical silver market in the world. When the rupee collapses, Indian citizens panic buy gold and silver to escape currency debasement. It is cultural, it is historical, and it is automatic. On April 14th, 1 day before the halt, South Korea's Kospi stock index fell 11.4% in a single session. Not the April 4th crash that took it down 18%. This was a separate crash 1 week later. Korean retail investors were in full liquidation mode, selling equities and moving into physical precious metals. Bullion dealers in Seoul reported lines out the door on April 14th. This was not speculative, this was survival buying. So in the 48 hours before silver trading halted on COMEX, you had the Indian rupee hitting all-time lows and the Korean stock market crashing double digits. Both events trigger massive physical silver buying in Asia. Asian dealers were calling refineries in Singapore, Perth, and Zurich, demanding immediate delivery at premium prices. Refineries were diverting metal that was already allocated for export to the United States and selling it domestically in Asia at higher premiums. The physical flow to the West was being severed in real time, and COMEX vaults were watching their expected restocking shipments vanish. That is the supply disruption that triggered the volatility circuit breaker on April 15th. Not a geopolitical headline, a physical delivery crisis. Here's the number that confirms it. In the week ending April 18th, 3 days after the trading halt, COMEX registered silver dropped from 78.0 million ounces to 76.88 million ounces. That is a 1.12 million ounce withdrawal in a single week. But here's the detail that matters. Of that 1.12 million ounces, 890,000 ounces were moved from registered to eligible. That means the metal stayed in the vault but was reclassified as unavailable for delivery. Why would metal be reclassified as unavailable in the immediate aftermath of a trading halt caused by volatility? Because the vault owners know that the next delivery cycle is going to be brutal, and they are preserving their metal. They are taking it off the table before May 1st notice day, which is now 6 business days away from today, April 23rd. We are sitting here today with 76.88 million ounces in registered COMEX vaults and 235.2 million ounces of open interest in May contracts. That is 3.06 ounces of paper claims for every ounce of deliverable metal. And vault operators just reclassified 890,000 ounces as unavailable in the week after a mysterious trading halt. They are preparing for something. Now, let me tell you what broke publicly 90 minutes after trading and resumed on April 15th that supposedly caused the halt. At 4:40 p.m., Reuters reported that a container ship in the Strait of Hormuz had been approached by Iranian Revolutionary Guard vessels. No shots fired, no boarding, just approached. The ship continued on its route. That was the geopolitical escalation that CME Group cited as the reason for halting the most liquid silver market in the world for 47 minutes. Does that sound proportional to you? A container ship getting approached, not attacked, not boarded, approached, triggers a market-wide trading freeze that results in a $4.30 repricing? Or was the halt triggered by something else entirely, and the Hormuz incident became the convenient public explanation after the fact? Here's what I think actually happened. Refineries in Asia were being overwhelmed by physical demand from Indian and Korean buyers in the wake of currency and equity crashes. They were diverting export shipments away from COMEX restocking orders. COMEX vault operators realized that expected inflows were not coming. With May delivery 16 business days away at that point, and open interest already showing a 3-to-1 imbalance, the vault operators communicated to CME that a supply crunch was imminent. CME halted trading to prevent a disorderly panic spike while they sorted out who had metal and who did not. When trading resumed, the price was $4.30 higher, because that is where physical metal was actually trading in Asia. The paper market was forced to catch up to the physical reality. And then, over the next 8 days, the price was walked back down through coordinated paper selling to push silver from $87.75 back to $77.70 by today, April 23rd. The physical tightness never changed. The price changed. That is manipulation in plain sight. Let me give you another data point that did not get enough attention. On April 16th, the day after the halt, the London Bullion Market Association reported that silver lease rates spiked to 39% annualized. Lease rates represent the cost to borrow physical silver for short-term delivery. When lease rates hit 39%, that means there is no physical silver available to borrow at reasonable rates. You are paying 39% annualized interest just to access metal for 30 days. That only happens when the physical market is in extreme backwardation, when spot delivery is worth more than future delivery because there is no confidence that metal will be available in the future. Lease rates at 39% the day after a trading halt is not a coincidence. It is confirmation that the trading halt was driven by a physical shortage, not a geopolitical headline. And yet, 8 days later, here we are with silver at $77.70 and the mainstream financial media acting like nothing happened. CNBC is not talking about 39% lease rates. Bloomberg is not investigating why trading halted before any news broke. The Wall Street Journal is not asking why open interest dropped 92 million ounces in the 3 days before the halt. Because if they asked those questions, they would have to admit that the silver market is broken, that the paper pricing system is divorced from physical reality, that COMEX cannot deliver against its own contracts without triggering a systemic crisis, and that admission would accelerate the very crisis they are trying to prevent. Today is April 23rd. We are 6 business days from May First Notice Day. There are 235.2 million ounces of paper claims and 76.8 million ounces of deliverable metal. In February, COMEX delivered 25.18 million ounces, a record for a non-primary delivery month. If May sees delivery demand anywhere near that level, we are looking at a drawdown of 25 to 35 million ounces in a single week. That would take registered inventories below 50 million ounces. At that point, the coverage ratio falls below 10%. There has never been a COMEX delivery month with coverage below 10%, ever. If we cross that threshold in the next 2 weeks, the probability of another trading halt goes vertical. And this time, the halt might not be 47 minutes. It might be hours or days. Here's what else is happening today that feeds directly into this. At 9:45 a.m. Eastern, the April Flash PMI releases. This is the real-time read on whether the U.S. economy is expanding or contracting. March services PMI came in at 49.8, contraction territory. If April confirms a second consecutive month of services contraction, stagflation is officially here. And stagflation is the exact macro environment where physical silver outperforms every other asset class. At 8:30 a.m. Eastern, initial jobless claims released. Last week came in at 207,000, below expectations. If today's number spikes above 220,000, that signals labor market cracking. Fed cannot cut rates with inflation at 3.3%, but the economy is weakening. That is the trap. Entrapped central banks with zero real interest rates are the best friends precious metals have ever had. Freeport-McMoran and Newmont both report earnings today. Freeport produces 18 million ounces of silver annually as a byproduct of copper mining. Newmont produces 25 to 30 million ounces. Combined, these two companies represent nearly 50 million ounces of annual mine supply. If their production guidance comes in below expectations due to higher energy costs, oil is at $94 per barrel, that removes supply from an already deficit market. And then there is Iran. Trump extended the ceasefire on April 22nd, but Iran has not submitted the unified proposal Trump demanded. It has now been more than 24 hours of silence from Tehran. Iran attacked 3 commercial ships hours after the ceasefire extension, and the White House said that was not a violation because they were not U.S. or Israeli ships, which means the rules of engagement are undefined. Anything can happen. And when anything can happen in the Strait of Hormuz, oil stays elevated, inflation stays elevated, and silver stays bid. Let me bring this back to April 15th. The 47-minute trading halt was not an isolated event. It was a warning shot. It was the market telling you in the clearest possible terms that the current pricing system is unstable and that physical supply is far tighter than the spot price suggests. Since April 15th, we have seen COMEX registered inventories drop another 1.12 million ounces, 890,000 ounces. Reclassified from registered to eligible London lease rates spiked to 39%. Shanghai premiums hold at $12 to $15 over spot. Open interest rebuild to 235.2 million ounces. May 1st notice day approached to 6 business days out. Every single one of those data points confirms that the physical market is tighter today than it was on April 15th. And yet the paper price is $10 lower. That is not a market functioning properly. That is a market being managed. The April 15th halt happened because the physical shortage threatened to overwhelm the paper system. The $4.30 spike was the market trying to reprice to physical reality. The subsequent $10 decline over 8 days was the suppression campaign to push the price back down before May delivery. But the fundamentals have not changed. The shortage is still there. The delivery imbalance is still there, and the next catalyst will trigger the same repricing event. Except next time, the halt might not end in 47 minutes. Here's what you need to understand as we sit here on Thursday, April 23rd, 2026, with silver at $77.70. The April 15th trading halt was a test. It showed the system's breaking point. It revealed that large players have advanced knowledge. It confirmed that physical tightness can force a repricing event even when the paper market is trying to suppress. And it demonstrated that the exchange will intervene directly to control price discovery when the situation gets out of hand. You now know that silver can go dark without warning. You know that 47 minutes of frozen trading can result in a 430 move that you have no ability to trade. You know that the vault inventories are being reclassified as unavailable in advance of delivery pressure. You know that lease rates can spike to 39% overnight. And you know that all of this can happen while CNBC talks about equity earnings and the Federal Reserve pretends everything is fine. The people who owned physical silver on April 15th were unaffected by the trading halt. Their metal did not disappear. Their value did not freeze. They were not locked out of the market. The people who owned paper contracts got a 47-minute lesson in counterparty risk. 6 business days until May first notice day. 235.2 million ounces of paper claims, 76.88 million ounces of metal. The math has not changed since April 15th. The question is whether the outcome will.